This was Jay Powell with a hawk hat on, but how would you characterize his message, and does it put to bed now the idea of rate cuts at some point in 2023? Morning to you, sir.
I think this was a speech which is almost straight out of the economic textbooks. I mean, the one thing that the equity market seemed to have been convincing itself of most of last week was that, yes, we're going to get some sort of hint that maybe the rate of increases would begin to be moderated, or that perhaps there'd be a hint that sometime in 2023 things would come down. And if you think about it, that would have been tightening on the one hand through putting up rates, whilst at the same time loosening overall financial conditions by offering this sort of get out of jail free card. And that wasn't going to get Powell where he needed to be. So he stuck completely to his guns. First, foremost, in fact, the only message is getting inflation on track. No trade-off between inflation and growth in the short term, long term, or any term. Almost a European point of view of monetary policy approach. And I think he delivered what he needed to do.
Rob, how do we explain such a negative equity market reaction? It seems like a lot of equity traders were caught out by some of his comments. Bond traders, not so much, though.
Yeah, I think that's right. I mean, there has been a disconnect between the equity market and the bond market. At times, the equity market has been driven down by rising bond yields. But bond yields have been nosing higher for some time now. If you look in particular at things like the Fed funds futures implied yields at the end of 2023 and the end of 2024, I mean, both of them are suggesting now that rates will have risen and stayed high for quite a long period. Now, that isn't really being reflected in equity prices. We've seen a bit of softness from time to time, but to be honest, the equity market's still not really pricing in a recession. And Powell's saying you need a recession to get this under control, to get inflation down. And I think that's really where the equity market has to start thinking now. What's the right price for a US in recession with high rates thrown in?
So the US is already in technical recession. Rob, is a full-blown recession a base case now, in your view, given the rate hike trajectory to come?
I think if you read between the lines of what Powell is saying, it's almost a requirement. We do have this disconnect between supply and demand. He has to weaken the economy sufficiently to bring demand back into control of supply. And he can't do a lot about supply, which suggests that most of the heavy lifting is going to have to be done through the demand side. And realistically, that means some sort of recession. The really only big question is how bad, how long is it going to be?
Exactly, and those questions still very hard to answer at this point, given the current economic trajectory. But Rob, let's talk about the forward guidance that we saw from Chair Powell. Interesting to hear him talking about how another, quote, unusually large increase might be necessary moving forward. What does that mean for September, and are we now edging closer towards 75 versus 50? Of course, he says it's going to be data dependent, but what's your base case at the moment on what happens in September now?
Well, I think the base case is really still very much data dependent. We don't know, he doesn't know. And I think that's why he's keeping his options open. We still have one more inflation release before that next FOMC meeting. We also, and perhaps this is just as importantly, we have another jobs report. Now, if the economy continues to be adding jobs at the sort of rate that it did in the last month, 500,000 a month, I mean, that's not consistent with getting inflation under control anytime soon. So even though we might see some further moderation in headline inflation, as some of the energy prices, maybe sort of moving sideways rather than hurtling higher, I think that's going to be the judgment is inflation coming down enough to offset the fact that large parts of the economy still look to be extremely resilient, and they'll just have to make that choice on the day, as we will, because no one can predict payrolls.
So as it stands, just to press you on that point, 50 or 75, the ING house view in September?
I think we're 50 at the moment, but we'll be quite happy to change it if we get a strong payrolls.
Indeed. All right, watching those payroll numbers, watching the CPI print as well. Rob, before I let you go, also headlines developing over the weekend out of the ECB with officials warning of the sacrifice needed to tame inflation. Of course, we're looking at major headline energy risk across the Eurozone as well, which has the potential to push the bloc, you could say, into recession if it isn't already. How closely is the ECB watching what's happening over at the Fed, and what's your assumption on how they're going to be navigating some of these challenges moving forward?
Yeah, I think the ECB is a very different, actually rather harder proposition than the Fed. I mean, the Fed starts off with a very strong economic backdrop. The European Union, the Eurozone, doesn't. It's going to have to raise rates. It's going to have to get its demand down further to get inflation into track, but from a very much weaker starting point. It's a much tougher trade-off for them. So, yeah, they'll be looking at what the Fed does. They'll also be looking at what's happening to their currency, which doesn't exactly help getting inflation under control either. So a much tougher set of policy choices for them, I think, than the Fed.